note that we do have a quorum and remind everyone that we are streaming via YouTube. First order of business, we're going to approve or hopefully approve the Finance Committee minutes of February 26, 2025. I'd like to ask for a motion to approve the minutes of the February 26, 2025 meeting of the Finance Committee as presented.
So moved. Second.
All in favor?
Aye.
Any opposed? Any abstention? So with the minutes approved, we're now going to hear from Mr. Blake, and who's going to introduce a new partner that we have, Mr. Strickland. And I'm going to turn it over to you, Mr. Blake, and give us a report on our investment committee report.
I want to introduce a new colleague to Clearstead. This is David Strickland. So he's a newer member of the Clearstead team, highly experienced. He spent the last 15 years at JP Morgan in Columbus, and a win for Cleveland and Clearstead that he's moving up here to Cleveland. He's in process of doing that. So glad to bring him on. And also, by the way, Claire is still part of the team. She couldn't make it today, but you'll see her as well in the future. We've got about 15 minutes of updates to share with the committee. So I'm not sure if everybody has the slides, but I'll cover the.
I can get them, put them up.
There we go. Great. On the next slide, I'll cover the oversight dashboard. David's going to talk about capital markets and some things that we're seeing out there. We have performance through March, and just given a lot of volatility out there in the markets, we wanted to give the committee an update into the second quarter. We have good news to report if you've looked ahead. And then we'll finish with a strategic asset allocation analysis and policy review. So the oversight dashboard's on the following page. Looking ahead to the next meeting, which is scheduled for August 27th, we'll spend time on fixed income, just looking at the underlying characteristics within the portfolio, and also the annual fee review. So next, we'll get into the capital markets review, and I'll let David make some comments.
Well, good afternoon, everyone. It's a pleasure to be here and looking forward to working with you. So let's dive in right into markets onto slide 5, please. 2 more. You skip to the next slide, please. Thank you. So slide 5. So we began this year with a backdrop of heightened policy uncertainty, especially around tariffs, which drove much of the volatility this year that Adam alluded to. You know, that uncertainty reinduced slower growth with higher inflation, and markets reflected some of that tension regarding those concerns of slower growth. And so what we saw is U.S. equities had negative returns. They were down 10%. Or U.S. equities were down, and led by that decline was 10% decline in growth stocks in particular. International equities outperformed, helped by a weaker dollar, and value stocks outperformed growth. And so that was actually a reversal of some recent trends we've seen in equity markets recently. And fixed income markets, you saw positive performance there. So key takeaway in the first quarter is having a diversified portfolio worked well in the first quarter. Next slide, please. So this chart shows you the S&P 500 returns and calendar year returns alongside the intra-year drawdowns. And we've seen significant volatility this year in equity markets. And so we saw earlier this year, we saw the S&P 500 draw down almost 19%, peak to trough, largely in response to the tariff announcement. And that had some surprise effects to the market that we witnessed. The markets rebounded sharply after the 90-day pause on reciprocal tariff was announced by the Trump administration. And as of today, U.S. equity markets are actually slightly positive year to date, which feels counterintuitive given how eventful headlines have been. Next slide, please. So, one more slide. There you go. So turning to the Fed, In terms of policy, the Fed is taking a wait and see approach. So they're closely monitoring how tariffs will affect the economy. And, this chart shows you their latest projections on economic projections for the US economy, which it shows is slower growth and higher inflation forecasts. The Fed has signaled this year that they're prepared to cut rates in the second half of this year if they see growth slowing and weakness in the labor market. You can go 2 more slides, please. In fixed income, as I mentioned, we saw positive returns of fixed income. This is driven by lower yields in the rate market. You saw some widening of credit spreads modestly, but despite the noise, fixed income delivered positive returns this past quarter. And I think I want to leave you with this. I think it's important that in today's higher yield environment, it's actually going to be positive for bond outlook. For your particular in the system, your portfolio in particular, it's going to help reduce portfolio volatility, provides higher income, and supports long-term growth, supports the long-term goals for the system. So I'm going to pause there and see if you have any questions.
Do you have a sense of how much cash is on the sidelines, sort of watching and waiting?
Yeah, I've seen a lot of estimates of $6 trillion in money market funds still sitting on the sidelines, ready to deploy, because given where yields are, higher yield environment, it's a nice place to be. You think about back in 21, whether you had 1% yield on the 10-year, and so you're actually seeing a much higher yield environment. So people are sitting in cash.
Is there any way to predict what percentage of that cash will move in what direction by historical standards, or are we in such a new world that it's not worth speculating? Do you understand the question?
Yeah, I understand. Yeah, I think it's one of those, you're going to have a catalyst. You're saying, what's that catalyst event going to be? I think what we're seeing is people wanting to lock into those returns for longer. Think about cash. It's only 90 days. You're holding it for 90 days. And if the Fed begins cutting rates, that's going to eat into cash returns. So potentially what you're going to see is folks moving out into bonds and locking in yields for longer. So that'd be a potential catalyst if you see more signs of, Federal Reserve cutting rates.
Are we worried, or should we be worried about Moody's downgrading and the other credit agencies as well?
Yeah, just alluding to the Moody's downgrading U.S. government and the U.S. Treasuries a couple of weeks, actually the other week, and they were the last major rating agency to downgrade the U.S. government. I think it's really the concerns of around the new reconciliation bill that's coming out. It's actually going to show deficits higher for the U.S. economy. We have bloating deficits, and that's the concern for a lot of the rating agencies. Right now, in the near term, we don't see, in terms of any issues in terms of folks like the U.S. Treasury market. It's still going to be a robust market. There's a lot of liquidity for the U.S. government, and that's still going to be, the dollar still is the reserve currency. But it does think about long term what the U.S. government is going to do in terms of getting their house in order with fiscal deficits.
Last question. Do you see any pause or shift of foreign investors in terms of their confidence in the United States economy? Structurally, not transactionally.
Yeah, I mean, I think you're seeing some signs of that, particularly in April. And when you saw some of the volatility, I think a couple of charts ago, I showed you the S&P 500 returns going back in 23 and 24, you had cumulative returns of 51%, the past 2 years. This year, you saw some of what I think part of the decline in the stock market, the volatility and concerns around tariffs, but it's just, you've had such a great performer for U.S. equity markets. You see some of that rotation to repatriate some of those assets back into their home currencies in Europe, particularly. And so I still think that it's really gonna be driven by, one is investors gonna see where's the innovation is gonna be coming from, where's the growth gonna be coming from? And you still think that you see the US exceptionalism still hold within, in the US, it's still gonna bring in assets in. So I don't see too much concerns of investors rotating out of US markets. Any more questions? I'm gonna pass it back down.
All right, thank you, Dave. All right, to go into the next section on the performance update. On the next slide, this is an important summary that we worked with Derek and his team on to capture key Ohio Revised Code and investment policy guidelines. So we've pulled this out of your investment policy and we're just simply stating to the committee that we've done a thorough review and everything is in compliance with the policy.
I have a question. There's a notation that the reserve pool temporarily fell below the $300 million requirement. Why was that, and how long was it for?
Yes, good observation. So, and Derek can chime in on this, but there are cash inflows and outflows into the cash accounts within the system, and I think there's some timing aspects to it, and we're constantly monitoring those balances. So as we've done historically, if that balance falls below 300, we do some rebalancing to put the portfolio back into compliance. It was over.
This has happened before.
It's happened at times, and so it's sort of routine rebalancing. So no issues from our standpoint.
And John, we would do the same thing if we became overweight in
Right.
equities.
Yeah.
Then we would rebalance the.
Yeah, I understand the
portfolio.
rebalance.
Yes.
I was just concerned that we'd fallen below that number, and I didn't know for how long that had been, or if it was just, are we talking a couple of weeks? Are we talking a month or?
A couple of weeks.
Yeah, weeks.
Okay.
Yeah, when it came to our attention, then we rebalanced.
On the following slide, we track the underlying investment managers by some criteria, which we've started this the last couple of quarters. It's a watch list just for additional oversight. Slide 13 is more quantitative in nature, and what I would report to the committee is almost all of your investments outperform their respective benchmarks for the quarter. We have no concerns qualitatively, so all is in good order at this point in time. Moving to slide 14, taking a look at total system investments. So at the end of March, the system had $527 million in investments. The Select Assurance captive had around $119 million in investments. So it combined about $646 million. On slide 15, so just focusing on the system investments here, and as highlighted in that green box at the bottom, which is interesting, kind of adding to what David said a moment ago. Within the non-reserve pool, that's where you have equity exposure. Equity markets were down and the non-reserve pool was down, but the reserve pool, which is more conservative, attractive yielding cash and short-term fixed income, they virtually offset one another. So the investments were essentially flat for the quarter, although equity markets were down. On slide 16 is just looking at it in percent terms, so flat for the quarter, and on a 1 year basis, the system investments were up 5.6%. On slide 17, Select Assurance captive for the quarter was actually slightly positive. This portfolio is about 50% stocks and then 50% bonds, so it saw a slight gain for the quarter. And then on slide 18, just to give the committee an update on where things are more currently, just because markets were moving quite a bit. This is a snapshot of the investments through May 16th. This is just the system investment, so that this excludes the $119 million or so of the captive. So the remaining investments were valued at around $528 million. The reserve pool, as you can see, is over $300 million, about $318 million as of May 16th. The good news is in the second quarter, the investments in the non-reserve long-term pool, that's where you have equity exposure, we're up about $8 million, or about 5 to 6% so far in the second quarter. Again, reserve pool over 300 million, and everything is within the compliance of the investment policy. All right. I'll move into the last section. So annually, we do a strategic asset allocation review. There's a number of different types of risks that we look at. So we look at risks holistically, and those are detailed here on slide 20. On slide 21, annually, the research team at Clearstead evaluates what do they expect to earn in different segments of the capital markets, not for 2025 or 2026, but this is a 10-year forecast, so an average over 10 years. And we do this every January. Equity market expectations have come down a little bit from a year ago. Fixed income and cash expectations came up a little bit, so the net difference is about the same from a year ago. We apply these long-term capital market assumptions to the portfolio on slide 22. We broke the portfolio up in a number of pieces here. The reserve pool and the non-reserve short-term are cash and short-term fixed income. So we're forecasting those pools to earn about 4% over the next 10 years. And there's obviously a range of outcomes around that. The long-term pool, we're estimating a 6% rate of return, combined system of around 4.5%, and we're estimating about a 6% rate of return based on asset allocation for the captive. Yes, sir.
Our board policy, which on investments really guides us here, but it's silent on the term Bitcoin. So, and I don't understand Bitcoin, so I'm not advocating on its behalf. But it strikes me at some point we ought to get some clarity of what we mean, what that term fits in. And we have a phrase, alternative investments, might be there. It could be other places, but you know, John, I defer to you to say at some point we may want to contemplate clarifying our view on that.
Well, I think we would have to go back to the county and get them to change the policy in order to do that. So the policy was approved by the county when it's all set up. So they said we can only have so much in foreign investments or alternative investments and all that. So that would have to be.
So do you think Bitcoin would be the alternative investment?
No, I think Bitcoin would be in this portfolio.
I mean, it says we can't do alternative
Right,
investments, which is good.
Yeah, we fall in the alternative investments that category. Yeah.
Mike, we would not do digital currencies.
Good. I don't know if you understand it, Derek, but I struggle to get a grip on it.
Every time I think I understand it, and I realize I don't.
So neat.
All right, so stay away.
Everything is very plain vanilla within the investments by design and all entirely liquid. And that's actually required via the policy. Slide 23 is an interesting one, and I thought this would give some good context for the committee. This is a sensitivity analysis. So what we're doing is we're taking into account the characteristics of the portfolio. So just at a high level, keep in mind about 70% of the system investments are in fixed income and cash, about 30% in equity markets. So it leans fairly conservative. But what this analysis allows you to do is to play the what if and stress test the portfolio. And the example called out here is, you know, given the characteristics of the portfolio, if the equity markets were down 15% this year, and in the same time, the yield curve, yield shifted down by 50 basis points. Typically, stocks and bonds move in different directions in that regard. The resulting system investments we would estimate to be down about 0.8% or about 1%. So 1% is about $4 million. And this is just speaking to the conservative nature of the portfolio. And it obviously would take a much more extreme outcome in the equity markets to push the needle. But we thought this would be helpful for the group to see. The last item we have, just to change gears slightly and going back to Trustee Summers' question on policy, we did a review of the investment policy, and what this schedule does on 24 is we wanted to pull out and remind the committee of some of the key criteria. We even bolded some of the text just to remind everybody of that. So, and I'll name a few of them. The investments must maintain liquidity. Costs of the underlying investments must be appropriate. We're going to do a fee review at the next meeting. The overall fee structure is very attractive. It's very low, so not an issue. This investment committee must meet quarterly per the policy. At a very high level asset allocation, the system must have a minimum of 60% in fixed income. You have around 70% in fixed income today. And also going back to the question on the reserves, you must maintain a minimum of 25% in reserves. That's per Ohio revised code. But beyond that, you also have to have a minimum of 300 million. So we look to maintain those criteria, but all of the guidelines stated herein. Are there any questions?
Well, perhaps just in the spirit of sort of the overview, as a governance chair, we need to look at this annually. So are we doing that? Are we meeting that standard by reviewing this and discussing it?
Well, we do have to send out to an RFP every 3 years, I think. So every year that kind of comes up again, because we send an RFP out.
Well, I'm thinking about policy.
Yeah,
Policy committee reviews the policy.
yeah.
The investment.
So I think the point is, I think you're doing a good service to us
Finance.
by taking our policy, reviewing it, and making sure we're doing it. And I guess the follow-up only question would be, is there anything missing or anything that's not clear to you that we should sharpen up in terms of our policy, which is, what policy was it, 6? BOT-06, which was developed in 2022. You were probably involved with that.
Yeah,
It actually goes back farther than that, but.
2018.
And this may not be the time we want to spend.
No, it's okay, right, so again, so we would have to, anything we change, major change, we have to go back to the county, we have to go back to get their approval. But I think, well, I mean, we could talk about it, we could put it on an agenda.
Well, I just would ask you to think about if anything's not clear to you, if our policy is vague or if things have changed, I think we would.
Or is anything tying your hands?
Not today, but you know,
Yeah.
through our relationship.
And we've shared with Derek, and I know he's dug, he spent a lot of time on the policy. I would say it's not perfect, but we're operating within it. And maybe there's a time at some point to get with I know that was a difficult task, so I'm not suggesting to try that again, but.
They didn't like our policy at the county, so they changed it, so it's good.
We're not gonna allow too much risk taking though.
Right, and for good reason.
Yeah, for good reason. Yeah.
What I would say is a government entity, the word perfect doesn't always fit with how governments operate. They're human.
Hey, well, thank you so much. In the interest of time, we're gonna have to move on. Taking place and next meeting. So, quick one. So now I'm gonna turn it over to our CFO, Mr. Hollings, who's gonna give us an update on our April 2025 interim financial report.
Okay, thank you very much. And can you put it on the screen?
And do you have a slide?
Pulling them up now.
Thank you.
All right, thank you. Well, I'm pleased to present the April 2025 financial results. With that, it was a pretty good month for us. And so I'd like to walk you through it. And let's start with the discharges and observations. And to the far right, where you have total discharges and observations, you can see that we've had progressive growth in total from 2023 to 2025. However, we are slightly behind budget in total. Moving over to discharges. We've had pretty fantastic growth in inpatient discharges. And I believe you could call this the Glick effect. Having a new shiny facility, inpatient volumes across the entire market, across the entire country have been stagnant. And so we've, since 2023, we've increased our inpatient volumes almost 1,000. Which is really impressive. And I'll get to this and I'll come back to it. The inpatient operations activity as it relates to, let's say, gross charges. This slide represent, for the most part, about 1/3 of our gross charges. And just to put that in perspective, and it is important because it's the revenues per unit is very expensive. In the 100,000 range and what have you, on the average gross charges. So it's an important indicator, but it's not the whole picture. And so next slide, and I'll get you there. The emergency department has been performing well all year. And through 4 months of this year, it continues to perform well in terms of visits and meet our expectations as when we plan as what percent of admissions would come through the ED, and it's about 81% in the budget. We had about 80. And so the ED, as it relates to a total working system, is performing as we thought it might.
The interesting thing about that is, the patient experience scores have also gone up too, so we're seeing more people, and we're also having a better patient experience at the same time, so that's pretty remarkable.
I would like to contribute some of that to Glick, but maybe it's just our smiling face. Next slide. If we've struggled here, but there's a lot that's happening here that on the surface may not jump off the page at you. So let's start to the far right and the bottom. You can see that total surgical cases, inpatient and outpatient, has been growing year over year over year. And that's where, and that's probably the most simplistic part of this. What is happening between inpatient and outpatient? There has been a shift of inpatient surgical cases to outpatient. And we are trying to get our arms around it and playing a little bit of the guessing game. And so if you look at inpatient surgical cases, you can see from 2023 to 2024, there was less inpatient surgeries, and from 2024 to 25, there was less. We were expecting more. We had planned for more. We have a number of initiatives working to grow the volumes, and we still think the activities are out there, and there's some efficiencies and effectiveness that we're working through. Well, yes.
Do we have a sense of what percent of our surgical capacity is being utilized?
Let me ask my clinical colleagues to weigh in on that.
Or Doug, you want to answer, or want me to answer?
Ballpark.
restate the questions?
Percentage of our surgical capacity that's been used.
How much of the total inpatient and outpatient surgeries?
Right. In other words, this is a key driver. How much room do we have to go without adding capital to grow more capacity? So
So,
that's what I'm.
yeah, so we do have slot capacity currently, which Dr. Golub's team is working on related to efficiency. We also have some slot capacity that's related to support staff and others to fully utilize the current OR footprint that we have. So before we invest more capital in building additional OR space, we do want to maximize our current capacity. So we have 20 ORs, for example, here at Glick, where we're using approximately 17 right now of those 20 due to some staffing constraints and others. We're wanting to expand that as we're able to. And then within that footprint, maximize the efficiencies that team's working on. I'm sure Dr. Golub, Dr. Maury may have additional thoughts on that.
That's exactly right. So using about 17 on a daily basis of our 20 rooms. And the staffing model changes throughout the day, so the number of rooms you can run at various times of the day goes down. So it's optimizing that curve, so definitely have room to grow from a surgical standpoint.
But not much, it sounds like, because we wouldn't want to be at a high level of capacity utilization because it would prevent unexpected demand.
Well, we, in those 17 rooms, we have 2 rooms that's running for the unexpected demands here at main campus. So that's your emergency general surgery cases that came in last night, need a surgery today. That's your, and we always sort of have a room, albeit everybody pulls together for our, what we call our A cases, which is the case that's got to come right now, the trauma cases that come in and have to go. So those are already included into those numbers.
Slot capacity is built for the emergency, right?
I think
So
based
we have
on,
that slot capacity.
based on Michael's question, I think that goes back to some, I think we did a presentation before at some point, going back and presenting first case on time start, presenting percent add-on cases per day,
remember
block
that.
utilization, looking at block, because the question you ask is answered in block utilization numbers. And first case on time start becomes, it's kind of going to the airport and that first flight takes off late. The rest of the flights all day then take off late. So they have metrics. I think that would answer your question you're
We do.
looking for.
Yeah, currently, first case on time starts is at 65%, which is below the industry standard. We want to be in the 90 percentile range for that. There's active work going on related to that. So that we do have quantitative numbers associated with all of those. And
But block utilization becomes the core metric that tells you how efficiently you use their operating room. Because an operating room is not an operating room. I'm sure you have some specialties. So you've got ortho, you've got trauma, you got ENT. So that each of those has their different blocks and they have their special rooms that those cases are done in. So you probably wouldn't do an ortho and an ENT suite because it's not equipped to handle that type of surgery.
Exactly. And we 100%, and we've been re-looking at block utilization across the system to the point of efficiency where we can't afford robots in every room for every possible surgery, right? So where do you consolidate equipment and time and effort and expertise so that you're maximizing your efficiency? You're not moving things around to different ORs. You have specific ORs dedicated to specific activities.
A wise old surgeon in chief asked me a question. How many surgical cases do you want to have left at the end of a day that you haven't done? And the analogy was, how many newspapers do you want on your newspaper rack if you were the newsboy?
Exactly.
So what's the answer? Brad? No, that's zero. If there's zero, you don't know how many, you want one left. So that tells you you've met all your capacity except for one. And when you fill that last newspaper and you're at 100%. So he was always striving to get it. So he always had the minimum number of add-on cases for the next day, because then it would maximize their block utilization and improve, experience for the patient. So,
Would it be reasonable to conclude that at the near term, 2 to 3 years, we do not view resource constraints as a limitation of this growth? Is that reasonable? Beyond that,
Dr. Walkie, the question.
And just relatively speaking, outpatient versus inpatient surgery, what's the revenue?
It's a very big difference.
Massive, like 20 to 1.
do you include, where do you put if you do a endoscopy procedure in an ambulatory surgery suite, does that count as an outpatient surgery?
We treat it as a procedure. It has its own category.
But it's not counted in your outpatient surgery?
That's right. It's not a case.
And where do you do your cataracts?
In the single one, so that's a case.
That's a case. So you're not doing it in an office. So is that in your?
That's a case.
Are there any That's where the center health affair is, that there's a big problem with the center health affair and it's the classification of or attribution of cases. So what you want to make sure is you really are truly only have outpatient surgery cases in that number. If you put endoscopy numbers, your revenue is even worse. So
So my point being, this shift to outpatient is not helping us revenue wise, correct?
It's causing us to change our cost structure.
Do
And,
we want to bring this in executive session?
Yes.
Okay, fair enough.
the
Let's go.
only, keep going.
all right, so, because we can do this again in executive session.
Okay.
Fair enough.
So let me speed it up. Next slide, please. So, outpatient visits and its related downstream revenues is worth about 70% of the gross charges. And it is an absolute dollar amount. That's where the absolute dollars sit today. And I'll show you this in the P&L. And for those who've been around a little bit and have some gray hair to show, or can remember when this was opposite. It was inpatient that was driving the bus and the economics, and outpatient was something that you did because you had to. And those days have changed. And next slide. And this story has been told a lot, and it's a very good one. And I'm gonna move you on to the numbers. Next slide, please. So let's do the numbers. So starting with gross patient revenues, and let me just stay at the top of the page, inpatient, outpatient. And you can see, let's look on the far right, actuals. You can see where outpatient revenues, 1,227,000,000 for the activities that we've spoken, and inpatient revenues is at 567 million, so more than 2 to 1. These days that outpatient is carrying the economic load, and you can see that if you look current month as well. And that drives what you do from this point forward in terms of how you operate and run the business. And that we as healthcare providers have been in a perpetual process of moving resources around and right-sizing and trying our best to stay ahead of the curve because of the changing dynamics of the inflow of revenues coming in. And so total operating revenues for the month of April, we exceeded our budget by 3 million. That helped to shrink the unfavorable variance year to date, the 8.7, and let me drop you all the way to the bottom of the page to EBITDA. April's EBITDA, we beat budget. Actuals, 14,426,000. Budget 11,133, and this is the highest EBITDA requirement that we've had through the first 4 months of the year. So that EBITDA, the bar was higher, and it will go up even higher. So we beat our plan. We are better than we were this time last year. And if I move you to the far right, we're at 28,419,000 EBITDA, which is $7.5 million better than where we were this time last year. So there is progress. We did not hit our target of 40 million. We were behind that. But operating income, if I could take you there, which is the next line up, and staying right, You have the prior year of 31 million loss and year-to-date 25.6, there is an improvement. So we are moving in the right direction. 4 months won't make the year, but we had to get through these 4 months in order to get to the end of the year. And there are a number of different initiatives that we have going on that would suggest that we are gradually improving, even though not at the pace that we had planned and that we desire. So I will stop on this page and take questions.
Any quick questions? I thank you, thank you, Derek. So with that, I'm going to move on to Dr. Shahadi. Going to talk about uncompensated care. We have a deeper discussion in executive session.
Thank you, Mr. Moss. I have the opportunity to discuss the unsustainable growth in our uncompensated care. Let me start by giving a little bit of definition, because definition helps us quite a bit understanding the numbers. Uncompensated care for Metro Health has two components to it. One component is a bad debt, and the other one is charity care. And let me just spend 1 minute at most to explain the difference between the two. The bad debt is the dollar amount that an individual, a patient, is supposed to be able, from financial standpoint, to pay their dues to Metro Health, which is in a copay or in a deductible. So these are, for the most part, insured individuals, patients that should have been able to pay their copays and deductibles. And when they don't, those amount of dollars go into the bad debt. Now, uncompensated care are mostly, but not all, mostly for the uninsured patients who fall into our charity policy and basically are determined not to be able to pay their portion of the care. And that goes completely to charity care. Some of them might be insured and still cannot afford the out-of-pocket and their copays. So this is the difference between the two numbers.
Dr. Shahadi, is charity, is it cost or charges?
These are charges.
Okay.
These are not costs. So if we look at go to the right side of the slide, the map, this is just to show that 90% of patients receiving the specific to charity care are resident of Cuyahoga County. So 90% of our charity care is within the county. Now, if we go to the bar graph on the left side, you'll see the evolution of the uncompensated care from 2020 to 2025. And for the unsophisticated eye, and any eye will be able to really jump to a conclusion that we were pretty stable in those numbers in prior year to 2024. So if you look at 2020, 2021, 22, 23, 2020, the total dollars between the charity care and bad debt was $226 million. And if you fast forward 2023, not much changed to $249 million. And that's probably because of our total operating revenue went up as well. And I'll show you on the next slide. But the starking difference is what happened after 2023 and the tremendous escalation of those numbers. So if you look at the difference between 2023 and 2025, just absolute number of the uncompensated care. So if you take the $180 million of charity care in 2023 plus the $69 million of bad debt, that equates to $249 million. $249 million. fast forward to what we expect in 2025, end of year 2025, that number will jump to $449 million. That is a $200 million difference within 2 years. Now, furthermore, if you look carefully into the proportionality of the charity care versus the bad debt, the bad debt is not growing as fast as the charity care. Actually, there was some stabilization between 2024 to 2025. We improved quite a bit, and that's a function of a much tighter revenue cycle processes that we have. That is collecting what you're able to collect from the patient and their portion and their responsibility. So if you only look at the charity care between 2023 and 2025, it jumped from $180 million to $369 million. That is doubling the number, more than doubling the number. So it's unsustainable growth. Next slide. Let's compare to how that looks in comparison to our total operating revenue. So let me explain a little bit that chart. It's a bar chart, and here we're only talking about charity care of the uncompensated care. So we're not including at all in this bar graph the bad debt. If we look at that as a proportionality of our total operating revenue, you can see in 2020 through 2023, it's around 10 to 11%. But you can clearly see that in 2024, our charity care as a percentage of our total operating revenue went up to 15.2% and expected to end the year, if we continue on the same trajectory, to about 18.3%. If we want to indulge ourselves and add the bad debt to it, add a 4% plus or minus to make easy math. That will equate to about 22% of your total operating revenue as uncompensated care. And that's really what I wanted to present and bring the attention to the board. Questions?
This more in executive session.
I might just forgot to make a very clear point here that while we don't have clear apple to apple to compare those numbers to others within our community, we believe that those numbers are at least 10 times more than our competitors in the community.
If we were doing costs, not charges, how different?
Yeah, that's why we're unable to compare apple to apple.
Any questions before we move into executive session? Rod, questions? That said, we're now going to move into executive session to discuss hospital trade secrets as defined by ORC 1333.61. Do I have a motion to recess into executive session to discuss these matters?
So moved.
Second.
Ronald?
Yes.
Roulette? Yes. Ms. Dumas?
Yes.
Mr. D?
Yes.
Mr. Kaczynski?
Ron's fine.
Loa Garcia? Not here. Mr. Jacobs? Ms. Mendez?
Yes.
John Moss, yes. Mr. Summers?
Yes.
And Dr. Walker?
Yes.
Okay, we are now into executive session. I'll ask the public to step out.
Mr. Chairman, we're also going to ask all members of
We don't have to do this.
Okay, we're out of executive session.
If there's no further business for the committee, this meeting is adjourned. Thank you very much.